Hi, it's me again. Teacher James. Today I am going to discuss about audit of inventories.
So what should be our objectives if we are going to audit the client's inventories? The audit objectives is to determine the following. A. Existence. Inventories included in the balance sheet physically exist. B. Inventories represent items held for sale or use in the normal course of business. C. Rights and obligations. Inventory quantities include all products, materials, and supplies owned by the company, on hand, in transit, or stored at outside locations. D. The entity has legal title or similar rights of ownership to the inventories. E. Valuations. Inventories are properly stated at cost, except when market is lower. F. Inventories are properly described and classified in the financial statements and disclosures are adequate. In order to achieve our audit objectives, we should make the best audit procedures. 1. Observe physical inventory counts. A. Test shipping and receiving cut-off procedures. B. Account for all inventory tags and count sheets used in recording the physical inventory count. C. Test the clerical accuracy of inventory listings. D. Trace test counts recorded during the physical inventory observation to the inventory listing. E. Reconcile physical counts to perpetual records and general ledger balances and investigate significant variations. F. Test inventory transactions between a preliminary physical inventory date and the balance sheet date. 2. Obtain confirmation of inventories at locations outside the entity. 3. Review perpetual inventory records, production records, and purchasing records for indications of current activities. 4. Analytically review the relationship of inventory balances to recent purchasing, production, and sales activities, and to anticipated sales volume. 5. Examine paid vendors' invoices, consignment agreement, and contracts. 6. Review direct labor rates. 7. Test the computation of standard overhead rates. 8. Examine analysis of purchasing and manufacturing standard cost variances. 9. Examine inventory turnover analysis. 10. Review industry experience and trends. 11. Tour the plant. Inquire of production and sales personnel concerning possible excess or obsolete inventory items. 12. Examine sales after year-end and open purchase order commitments. 13. Obtain confirmation of inventories pledge under loan agreements. 14. Review drafts of the financial statements. 15. Compare the disclosures made in the financial statements to the requirements of generally accepted accounting principles. Let us start solving some problems. I will give you a hint. Basically, in passage of title, you will encounter FOB, shipping point and destination. If FOB, shipping point assuming it's in shipyard or for shipment, the inventory will not be included in the seller's book. Instead, it should be included in the buyer's inventory. On the other hand, if we say FOB, destination, the passage of the title is passed only upon the arrival or receipt of inventory at the destination. Please read problem 1. One in the shipping room was a product costing $13,400 when the physical count was taken. Because it was marked hold for shipping instructions, it was not included in the count. The customer order was dated December 15, but the product was shipped and the customer billed on January 4, 2010. Number 1 is included, since merchandise, except special orders, should be included in the inventory until shipped. 2. On December 27, 2009, merchandise costing $11,648 was received and recorded. The invoice accompanying the merchandise was marked on consignment. Number 2 is excluded. Global company does not possess legal title because the merchandise was received on a consignment basis. 3. The company received merchandise costing $4,625 on January 2, 2010. The invoice, which was recorded on January 3, 2010, showed shipment was made under FOB shipping point on December 31, 2009. The merchandise was not included in the inventory because it was not on hand when the physical count was taken. Number 3 is included, because the purchase was made under FOB shipping point term. The merchandise should be included in the inventory on the shipping date. 4. A product fabricated to order for a particular customer was completed and in the shipping room on December 31st. Although it was shipped on January 5, 2010, the customer was billed on December 31, 2009 and it was excluded from the inventory. Number 4 is excluded. A product that is manufactured for a particular customer, special order, is considered sold upon its completion. 5. Merchandise costing $16,666 was received on January 5, 2010, and the related purchase invoice was recorded January 6. The shipment of this merchandise was made on December 31, 2009, FOB destination. Excluded. The merchandise was purchased under FOB destination term and was not received until January 5, 2009. 6. A product costing $150,000 was sold on an installment basis on December 10, 2009. It was delivered to the customer on that date. The product was included in inventory because the company still holds legal title. The company's experience suggests that full payment on installment sales is reasonably assured. Excluded. The sale is recognized even though legal title has not passed. 7. An item costing $65,000 was sold and delivered to the customer on December 29, 2009. The goods were included in the inventory because the sale was with a repurchase agreement that required the company to buy back the inventory on January 15, 2010. Included. This serves as collateral. Please read problem number 2. In this problem we will compute the November balance. Let us find relevant information to be used in computing the beginning balance or the November inventory balance in units. Year-end inventory is 43,500 units. This is also referred as ending inventory. Cost of goods sold can be computed as recorded sales of 138,630 units less 40,000 units consigned plus 15,000 units sold. Purchases with past title 3,600 units. F. O. B. Destination received last December 22nd. And 8,000 units. At shipping point last December 29th. Based on the following data we can now compute using workback method the beginning balance. Using the format, let's put the cost of goods sold of 113,830 units. This can be computed as recorded sales of 138,630 units less 40,000 consigned goods plus 15,200 sold of consigned goods. Since we know the ending inventory is 43,500 units, then by adding it back to the cost of goods sold of 113,830 we will get the goods available for sale of 157,330 units. Then we deduct the purchases for the month of December of 11,600 units. We can now solve the beginning or the November inventory balance of 145,730 units.